We're here with Carol Roth, the author of You Will Own Nothing and You Will Own Nothing. And also joining us now is Paul Stone. He's the co-founder and CEO of Colonial Metals Group, a Florida-based precious metal supplier that helps clients develop secure retirement plans by investing in gold and silver. Full disclosure, I'm investing with Colonial Metals, and they are an advertiser on the show. Welcome to the show, Paul.
Thank you very much, Jimmy. Good to be here.
So I wanted to talk to both of you about this. Credit card delinquencies surged in 2023, indicating financial stress, New York Fed says. Really? Is that what it indicates? Well, I wouldn't think that at all. Credit card delinquencies surged more than 50% in 2023 as total consumer debt swelled to $17.5 trillion. Debt that has transitioned. I like when debt transitions. Does that involve hormone blockers? How do you make a hormone? You don't pay her. Anyway, here we go. Debt that transitioned into serious delinquency or 90 days or more past due increased across multiple categories during the year, but none more so than credit cards. Wow, okay. And by the way, this is from CNBC, my favorite source of financial news for everyone who still believes the system works for them. With a total of $1.13 trillion in debt, credit card debt that moved into serious delinquency amounted to 6.4% in the fourth quarter, a 59% jump from just over a 4% at the end of 2022. The quarterly increase at an annualized pace was around 8.5%, the New York Fed researcher said. Delinquencies also rose in mortgages, auto loans, and other categories. I'm not an economist, but I bet this isn't good for the economy. Student loan delinquencies moved lower, as did home equity lines of credit. Overall, 1.42% of debt was 90 days or more past due, up from just 1% at the end of 2022. I'm not a math surgeon, but I think that's a 42% increase. I could be wrong. Credit card and auto loan transitions, again, they're transitioning into delinquency, are still rising above pre-pandemic levels. The signals increased financial stress, especially among younger and lower income households. Really, borrowers have been hit by higher interest rates in a tightening cycle that ran from March 2022 to July 2023. The Fed hiked its short-term borrowing rates by 5.2 percentage points, taking the Fed fund rates to its highest level in 23 years. The benchmark, since like 9/11, the benchmark rate feeds into most adjustable rate consumer debt products. Yeah, sure it does. Since the central bank began its tightening, the typical rate on credit cards leaped from 14.5% to 21.5%. That's a big leap. Credit card, that's like a 33% leap. I'm not a math surgeon. Credit card debt as a share of income is still below pre-pandemic levels. Really? While the rise in delinquencies happening from low levels, the trend bears watching because it is happening while the economy is still growing. Who said that? That's the chief economist at Nikko Securities. What happens if the economy slows and unemployment quickly rises? Well, delinquencies could surge, in turn leading to a self-reinforcing credit crunch. In other words, a mild downturn could turn into a deep one. Wow. So let me just ask you first, Paul, what do you make of that? What is a person like me, when I read a story like that, what should I think?
You should be thinking that though money is flowing into the economy, where does that come from? And to me, if it's not coming from the boots on the ground, the labor force itself, if it's coming from artificial means, it will flow through the economy. You'll see asset values rise. You'll see eggs and gasoline prices rise, commodity prices rise, but you're not seeing the income rise. So if we look back from 2020 to recently, there's a great economist out there that measured things by saying that pre-pandemic artificial fund level in the economy was around $4 trillion. Today, it's $19 trillion. When we look at the old-fashioned way of counting inflation, that would include energy, agriculture, shelter, healthcare, it's around 12.5%, though the Fed's equation has changed over the decades, and it says it's around 3%. What you're seeing is people being stretched beyond their means. Their income isn't growing, but the cost of everything else is. So they turn to these financial appendages, I like to think of them as a credit card, and they tap that until it's maxed. and now they don't have the money to pay that bill because they also still have to eat and they don't have money for that either.
Oh, so Carol, what do you say to that analysis?
Yeah, I think that one of the things that Paul's saying is that this really is window dressing of the idea that we have this wonderful economy. And it has been window dressed by a bunch of debt, both from the government and the consumer. You're seeing the consumer side here. We have the personal saving rate, which is at 3.7%. The historic average is about 8.5%. So people are dipping into their savings. We're also seeing, as we saw, record credit card debt. So people's, not only are their savings going down, but their personal debt is going up. And so their personal balance sheet is really what's supporting the economy in part. And then we have the government doing the same thing. You know, our $6+ trillion deficit last year as a percent of GDP is also double or more of the historical average of deficit to GDP. Now, normally when we run a big deficit, it's because the economy is not expanding. If you have an economy that's expanding, you get more quote unquote revenue in terms of taxes, and that usually means we have a lower deficit. But what they've done is they've used this big deficit to create this illusion of growth. And that is something that is highly unusual. So we're seeing, everything looks good, but it's being propped up by the debt, as Paul had pointed out. And that's why everybody's feeling a little bit of a disconnect, because they're going, it doesn't seem like it's a great economy to me, but I keep seeing that everything is growing. There's only so long that can go on for before it all comes apart at the seams.
So this is something that Paul was trying to explain to me before. So that they're artificially pumping up this economy right now.
Yeah.
And my theory would be why they're doing that is so they can get Biden reelected. And then if it crashes afterwards, who cares? Biden's already elected. And then if Biden doesn't get elected, and Trump does, they can blame it on Trump immediately, right? So it's kind of a win-win for them. And that's why I've been looking more into this financial thing, because when I started to see, okay, so the people who are running the economy now are the same people who decided to do the Ukraine war. And the Ukraine war is a proxy war against Russia economically. And they thought that they could put a hurt on Russia economically. Well, what it did, Russia's doing better now than before the Ukraine war. And it pushed them closer together with China. And it actually hurt Europe. Now, when they blew up the Nord Stream pipeline, Germany's now paying, I think, 2 or 3 times more the price for for their energy than they were before. So it's hurting their economy. It's hurting our economy because we're just throwing hundreds of billions of dollars at it, whereas it's not hurting. So the same people who are doing that kind of thing are the same people who are now propping up our economy using debt. And so now, in response to that, lots of countries are creating economic power centers to kind of compete with the United States with our hegemony and the reserve currency of the world. Because right now, let's remember, our economy is propped up by the petrodollar. Most people don't know what that is, but when Nixon took us off the gold standard, we then prop up our dollar because now Saudi Arabia, in an agreement for us to use our military anywhere in the world, they would agreed only to sell oil in American dollars. So now every country in the world has to keep American dollars as in reserve so they can use it to buy oil. And then it's just everybody uses it for everything now, right? But that's going away because now there are power centers like BRICS, right? So all these Brazil, Russia, China, India, South Africa, they're all coming together in economic partnership to oppose the United States. And Saudi Arabia started selling oil in other denominations besides U.S. dollars, which is bad for the petrodollar, which means, to me, it seems like everything is, if you thought the 2008 crash was bad, and again, I'm not an economist, I'm not a banker, I'm just a comedian who hosts a show and watches things and has a bullshit detector, it seems like things are about to crash even worse than in 2008. And I think that they've used all the ways that they can prop the economy back up. I think they've kind of run out of that. So when it does crash this next time, it'll be a much longer depression and it'll be harder to get out of that. What do you say, Paul?
Absolutely correct. one statistic that I think bears mentioning here is that since 2008, for every $11 the federal government has created in debt, that has produced $1 in revenue. So that'd be like Jimmy Dore Industries borrowing $11 million this year and having $1 million in sales.
Yeah.
That's not profitable, right? And so you look at, well, how is it the government thinks it should solve problems? It prints money and throws money at problems.
Yeah.
We could look at so many examples of how that hasn't worked. But back in the 2008 timeframe, the dollar was worth about 5 times what it's worth today. So
Really?
they still had some printing bandwidth. Or I like to make the analogy that if you consider the dollar coming out of a mine, like, you know, everything else, metal, gold, aluminum, iron ore, it all comes from the earth. If you thought of the mine producing dollars, the Fed as of today has removed 97% of the value of the mine. The dollar's only worth 3 cents. So where's the bandwidth or the mining capacity to continue to throw dollars at a failing economy?
So go ahead, Carol.
Can I throw 2 things in there? First of all, this may not be on your radar yet, but it's related to this using the dollar as a weapon against Russia. But the end of this month, I think it's the 24th of February, the G7 is meeting. And one of the things that they are trying to do is they're trying to find a legal way to take those reserves that they froze from Russia, about $300 billion worth, and quote unquote legally confiscate those.
Oh.
And you're going to love this one. Guess where they want to use those in? They want to use them in Ukraine. So yeah, I know this is very shocking to you, but so this is something, again, Larry Summers, who we talked about, former Treasury Secretary, is one of the names that's been talking, but this is a G7 discussion. It is out there. You can find these headlines on Bloomberg and elsewhere that they are trying to legally confiscate, whatever that means, somebody else's reserve assets, $300 billion. Between that and the fact of the matter that we have about almost $9 trillion in our own Treasury securities that need to be refinanced this year. And then whatever the deficit ends up being, another $1.5 trillion, $2 trillion, whatever it is, we have more than $10 trillion in terms of financing that needs to happen in the market this year. I think that the Fed is going to be forced, because of all of this debt and because of the fiscal dominance that's happening, that means the fiscal policy trumps monetary policy, that they're going to end up having to get involved with accommodated monetary policy again, which means either lowering rates themselves or perhaps printing more money. And so I think one of the things that you could see is you could see another push up in assets that happens again before things implode. And that's one of the biggest challenges. I think Paul will probably agree with me on this in terms of financial markets, is figuring out timing and duration. We can see trends and we can do our best to prepare for trends, but we never know the timing. And the US government and Fed, they have so many tricks. They really are able to stretch this out in ways that you wouldn't be able to believe. So I think it's important for us to know the trends, but also know that we don't know if this is going to happen in 5 days or in 5 months or in 5 years. We know we are on an unsustainable fiscal path. Everybody has said it, the IMF, the Fed, the Treasury. We know we've gotten debt downgrades. It's apparent. We know that nobody's planning to do anything about it. We just don't know when.
Yeah.
So so what you just said, that assets may increase because of this kind of money printing, right? Is that what I just heard you say?
Correct.
So what you're saying,
inflation, basically the same thing that we saw before, where the value of assets get pushed up and then everybody else's cost of living, that's who's paying the price here.
So does that necessarily mean stock prices will also rise?
It's very possible.
So that's what, okay. All right. I was just talking with Max Kaiser, and he was saying the same thing, that they are going to do this. And in the short term, it might prop up the Wall Street, right?
Right.
The stock market. It might. And so I'm like, well, why don't I just go put all my money back in the stock market again? But what you just said is, because no one knows exactly the timing. We know a crash is coming. There's probably going to be another bump, but there's definitely going to be a crash coming, right?
That's why we say diversification, because there's always cycles and we don't know when. And so we have to position ourselves for lots of different scenarios and have insurance for those difficult points when there is something that's a crash or a crisis or however they couch
And
it.
what do you do for, so like what I was telling people before and what I'm telling them now is that I talked to Ed Dowd, he told me this, I talked to Max Kaiser, talked to Paul, and now I'm talking to you. I put my money out of the stock market into T-bills, real estate, precious metals, and some in Bitcoin. And what do you say to that? What is your strategy?
So obviously this is not financial advice. That's the disclaimer that we need to give. You need to do it specifically based on your own risks and objectives. But my own approach is to have a very well diversified portfolio. So I'm with you in terms of the cash that I'm getting in that I don't have a use for today. I am also putting that in to short-term T-bills in a strategy that I call a ladder. So I might have some that expire in a month and some in 2 months and some in 3 months. And as they come due, then I evaluate and re-up them because they're earning, 5+%, with quote unquote fairly little risk in terms of the market on a short-term basis. But I also have investments in stock. I also have investments in precious metals. I also have investments in real estates and then some other alternative assets. So I do think you want to be thinking long-term, hard assets, but diversification is your friend, because if all of the asset classes go down at the same time, then we're in a very, very different scenario. And I think that that's going to be the least of our worries. So you want to have that insurance. And on the precious metal side, that's one way where you can get some nice insurance into your portfolio in a form factor that you can control, which I think, as maybe you guys would agree, is more and more important nowadays.
Well, that's what Max Kaiser told me. He said that the one thing that will keep up with inflation is precious metals, right, Paul? So.
Absolutely. If I could interject too.
Sure.
First, I think it helps everyone if they give a little context to how big the number 1 trillion is. So if we think of human beings making everything that we make on Earth is somehow to human scale, right? Office buildings aren't 30-foot story ceilings. It's like 10 feet tall, and elevators can fit a normal amount of people in. We don't make elevators that carry 100 people, right? So if we think of the number 1 billion, that's a billion seconds is 31 years. So most people are going to live 2 billion seconds old, not to make anyone feel older than they might feel today. A trillion seconds is 31,000 years.
Wow, that's a big jump.
So when we heard recently in the news that the Fed spent $1 trillion in 15 weeks, they spent 31,000, just one way to try to humanize the number, they spent 31,000 years of money in 15 weeks. Our federal debt of $34 trillion, and I don't even like calling it debt because debt has the assumption of being repaid. No one's paying back $34 trillion in debt. That's over 1 million years of money.
Wow.
America's been around for 250 some odd years, right? So when you think about just giving some context to the largesse of when we say credit card debt's $1 trillion and this is $1 trillion and now it's $1 trillion, it's beyond human comprehension of how we got this bad. And then you think, what does printing the dollar support? Does it support Wall Street? Does it support Main Street, the airlines, the restaurants, the diesel, the ships, the trains, the planes, and the automobiles? So how could I should consider carefully when I look at diversification about what supports that location of my money. If it's in precious metals, it's in a safe at home, it's in a depository. If it's in T-bills, it's something I have to rely on the government for. And maybe these days that's something I should be cautious of.
So how much of this has to do with the fact that didn't we go through some like a 20 or 30 year bull market on bonds? And then in 2022 that ended, right?
When interest rates are higher, generally there's an attraction to bonds. When interest rates are lower, like since 2008, there's an attraction to equities.
Okay, so am I, Carol, am I right about that? In 2022, the bull market on bonds ended?
Yes, because obviously, so basically bonds trade at an inverse with their yield or the interest rate. So as interest rates go up, the value of those underlying bonds go down. It's like almost like a seesaw, if you will. And that's, if you remember last year, this banking crisis that we had, that's part of the reason, because so many of these banks had these bonds that on paper, if they held them to maturity, it wouldn't matter. But on paper, if they needed to liquidate them, something that was worth a lot more a year before is now worth a lot less. And that's where they got themselves into trouble.
True. So if you're looking at short-term holds for bonds, the bond price would go higher as the interest rate drops. The bond price goes lower as the interest rate rises. Many folks are attracted to bonds for a long-term income source. And one other thing to consider is when we talk about timing, I hope I'm not misquoting him, the Oracle of Omaha. Warren Buffett once said, I believe I read it many times, to the individual investor, to the retiree, your job is to take big swaths out of the middle. There's no bell that rings at the top. And no one's going to build a statue in your yard if you get out on the last day the peak was reached. So be cautious, be careful, and be thoughtful about how important is it to actually nail a peak or a valley.
Oh, okay. So you're saying don't try to ride a wave and then get out at the crest. Try to get out.
Don't try to time the market in general. It's a fool's errand, and the returns are looked at over larger periods of time. So, again, obviously, if you personally believe that, everything's coming to an end in a short period of time, that's one thing. But time and time again, it's proven that the duration is sometimes, a lot longer than we could have predicted on this. And timing the market, there's pretty interesting graphs that show that if you miss, whatever the number is, the top 6 days of the market or the top 8 days of the market, that you miss a large part of the increases over long periods of time. So you have to be very careful. Even the very best folks like the Oracle of Omaha can't time the market. And that's one of the reasons actually why houses have been the largest item on people's balance sheets, individuals' balance sheets, in my opinion, because they consume those. And so they're not checking Zillow every day and being like, oh, I got to get out of here. It's the top of the market. It's very inconvenient. So they hold those over a long period of time, and they're able to ride those ups and downs.
I believe in having a substantial percentage of my financial future secured with gold and silver. This is actually real. This is true. I'm putting about 25% of my retirement. I never even thought about this stuff before. That's why I decided to partner with our sponsor, Colonial Metals Group. They helped me set up a safe and secure self-directed IRA. You know what that is, Jackie? Self-directed IRA, where I have access to my assets no matter what the stock market, and for that matter, whatever the government is doing as well. Let the team of experts at Colonial Metals Group help you protect your family's future. We've put together a special offer for our audience. Click on the link in the description below or call our special 800 number and you'll receive a safe and up to 10 grand in free silver. Go to colonialmetals.com/Jimmy-Dore-show or call 888-910-1419. Hey, come see us do a live stand-up show. We'll be in Bend, Oregon, Portland, Seattle, Philadelphia, Avenel, New Jersey, Boston, Palm Springs, Stockholm, Amsterdam, Rotterdam, Berlin, and London. We're adding a second show in London. The first show sold out. See you there.